If you look at the advent and the growth of the commodities complex over the last 3 to 4 years, going back to COVID, going back to the Russia-Ukraine invasion of 22, this most recent event over the last number of months in the Iran war has just proved yet another example of how crucial it is to have access to good liquid risk management tools in times of uncertainty. The broader story at CME Group going back 5 years has been one of record growth year after year after year. Energy, agricultural products, metals markets, they're starting to blend into one another as energy products are starting to trade more like agricultural products, as metals products like battery metals becoming trade more like renewable products. It is a fascinating space, and the consistent theme over the last 5 years has been realignment of global physical supply chains, and that's the business that we're in.
How have trading behaviors and product preferences shifted?
We often get the question, good volatility versus bad volatility. I tend to think about it in terms of, is it an indicator of risk on versus risk off? And when you look at risk on environments, it's where you see volume going up, where you see steady or increasing levels of open interest, meaning more people are carrying more risk in our products. You want to see broad participation across all client segments, institutional, commercial, end user, physical guys. You want to see buy side, you want to see banks, you want to see sell side, you want to see retail in there. The story of our markets over the last couple of years, even the last couple of months, and really strained energy markets has been broad participation across all client segments. The other two markers are good global participation across geographies, and these last 6 months we've seen record levels of APAC. That's been our fastest growing part of our business, followed by EMEA. Still strong growth in the US, but really seeing outsized growth outside the US. And then the last piece is options. We've seen a significant increase of customers adding options in addition to the futures they're already trading. And the story inside that story is we're seeing within the options growth a real significant increase of short-dated options 1 week and under. 1 week and under WTI options are up 90% year on year this year, 90%. Our short-dated options across the commodities complex as a whole are up fourfold over the last 4 years. So extraordinary growth on the option side, and I think that's helped customers manage through some of the really challenging landscape shifts over the last couple of years.
Which micro and short-dated contracts have seen the most notable adoption?
Initially, that was a push from retail brokers as we saw a great deal of retail interest wanting to trade more commodities, but the institutional grade size contracts were just not sized appropriately risk management wise for them. So we have worked with our retail broker partners to build out micros and then smaller than micro products, including 100-ounce silver, 1-ounce gold contracts that are trading 30 to 50,000 contracts a day. Those are market evolutions that were really driven initially by our broker partners on behalf of retail, but we're seeing institutional traders increasingly adopt shorter dated and smaller contract sizes for more precise hedging inside their portfolios as well. So it's a great example of adapting for one client base where the benefits accrue to all client bases.
How is international growth driving the regionalization of trade flows and pricing?
You have two trends that seem to be in conflict, but they support one another. On one hand, you're seeing customers drive towards a need for deep liquid pools of benchmark liquidity. So while customers want access to the price of oil, often that means, in our case, WTI, Cushing physically delivered in the middle of America, but a lot of our customers increasingly are in Europe and APAC. So how are customers continuing to avail themselves of deep pools of standardized liquidity for physically delivered oil in the US, yet they might be importing that product 6 or 10,000 miles away? Well, we built out a series of grades contracts that allow customers to hedge that price exposure from physically delivered Cushing out to the coast into the export market. So we're doing a number of things such that customers, as the US continues to both produce and export natural gas and crude oil at record levels, customers outside the US and Asia Pacific and EMEA are increasingly exposed to the price of US physical goods and oil and gas. So we've built products that allow them to avail themselves of that product that's actually relevant to their hedging needs, even though that's 6 to 10,000 miles away. So yes, there's a need for regional price management, but customers also insist on deep liquid pools of standardized products. So as exchanges, we try to build those pools, but also create basis markets to allow them to tailor make their hedges where we can do that for them.
What is driving the recent surge in open interest?
A lot of folks will look at exchange volumes and stop there. And the reality is there can be risk-off events in the presence of increased volumes. What you really want to say for a risk-on environment is volumes up and open interest up. And what we've been able to do is broaden our customer base. We're seeing record amounts of retail, of buy side, of commercial end user, of your historical commercial customer, and proprietary trading firms liquefying our markets to make sure that bid-ask is as tight as possible all throughout the day. That has enabled more customers to manage more risk around the globe as we run 23.5 hours a day, 5.5 days a week. We continue to see evolution, as we mentioned before, both in terms of shorter dated maturities for more precise hedging tools, but also smaller size contracts. The next evolution is going to be increased trading hours, and we've just begun to trade crypto products 24/7, and we've announced now WTI and gold as well. And that's just a pure response to demand from customers saying these are markets that actually trade in other guises, offshore unregulated markets. They would benefit from being able to have a regulated product traded 24/7 as well. So we've worked with the industry and worked with customers to bring that forward as well. And that's allowed more customers to carry more risk throughout these disruptions in pricing and manage that risk dynamically and keep them in markets and be able to manage their underlying exposures very effectively.
Is market infrastructure ready for widespread 24/7 trading?
When we look at 24/7, we're really looking at customer demand. What do customers have access to today? What would they like to have access to today? And what's going to come over time? If you look at what our customers have access to today, crypto underlying markets were trading not just Monday to Friday, but Saturday and Sunday as well. So we started by responding to unmet client need today, which was weekend trading in crypto where those markets already exist. So we launched that, went live a couple of weeks ago. We had always had a roadmap in mind in terms of what customers are telling us they would like to see next. With the growth of offshore perpetual markets and unregulated markets, there is already weekend trading in crude oil and gold contracts. And customers have said, well, we know the benefits of trading in a regulated market with investor and customer protections of a clearinghouse and all the investment and protections that come from that. So they said they'd like us to enable that same environment of customer protections inside a regulated market for weekend trading in those two asset classes as well. We've developed two very small size contracts, very appropriate for retail trading. 1 ounce gold, which trades today, will extend into weekend trading, and then a new 10-barrel WTI contract, which is 1/10 the size of our micro contract, 1/100th the size of our main benchmark contract. Those are the only two products we'll trade, both cash settled, on weekends, and that's consistent with client demand for where they're already seeing trading in other unregulated markets. They wanted a regulated version of that, and that's what we're bringing forward in July and August for gold and WTI respectively.
How is the energy transition shifting your new product development?
The lifeblood of any exchange is new product development and listening to client demand. We have made mistakes over the years thinking about great ideas that we think would make good products that customers didn't need. That generally is not a successful roadmap for putting products out there that grow. We've learned over time that the most successful product development is based on client demand. So back in 2017, 2018, we listened to our customers that as the EV transition was accelerating, they recognized there was no regulated marketplace for managing EV battery risk pricing, the ingredients into EV pricing. So whether it was cobalt, lithium, molybdenum, spodumene, any of the ingredients into battery metals and battery ingredients, we worked with the customers to build those markets out. We've been listing those markets now for about 7 years, and those continue to trade at record amounts and with record amount of open interest. It was initially just a commercial market. Now we've got hedge funds, asset managers, and banks in there as well as those markets get more liquid and broader adoption as we build out more products. As we think about what that energy transition looks like over time, it impacts not just traditional markets, and I would put soybean oil as a surprising benefit of the energy transition, as soybean oil is the feedstock for renewable biodiesel, but I think you look at brand new markets like compute futures that we've announced with Silicon Data as our partner and our PRA building an index on the back of that. That is a fascinating connection point between natural gas as an input into electricity and power markets, and power markets being an input price into compute. You can hedge natural gas, you can hedge power, you can't currently hedge compute price. And so we're working with customers and working with Silicon Data as the price reporting agency on the index they developed to build out a product suite that will help customers manage that as data center growth continues to grow and as artificial intelligence continues to be a driver for global adoption. That's something that our customers have asked us to build into, so we're excited about that, and we look to roll out product later this year.